Welcome back. Let's kick off this hour with a conversation with a strategist in Louisville, Kentucky. Ross Mayfield joins us. He's investment strategist at Baird, and he joins us right now. Good to see you again, Ross. What's your take on these markets as clearly tariffs is the narrative on investors' minds right now?
It is the dominant narrative, and I think clearly some of the weakness here is related to both, the potential for higher tariffs and the broader tariff uncertainty. Even in something like the ISM services report, which came in strong today, most of the commentary is about the uncertainty around tariffs. But I would also say that, this sell-off really began on the back of an economic growth scare that came from both Walmart's cautious guidance and then the flash services PMI a couple of weeks back that showed contraction. So I think we're in a tricky spot right now because there's as much an underlying scare about economic growth. You saw ADP jobs come in a little soft today, as there is about the potential for, tariffs to weigh on profits and potentially spark a second wave of inflation. So, ultimately remain bullish, but think that there could be some more downside weakness here given the kind of cacophony of headwinds.
Why are you bullish in the longer term?
I think two major reasons right now. Number one, we just wrapped up a fourth quarter earnings season, and while every company is mentioning tariffs as a potential headwind and talking about tariffs ad nauseum, we just printed the best quarter of earnings growth for the S&P 500 since really the COVID-19 pandemic recovery. So the corporate fundamentals are on really solid ground. There are a lot of tailwinds there that are not as discussed as the potential headwinds in the form of tariffs. But there's still potentially tax cuts to corporate on the time horizon. There's the deregulatory narrative. And then broadly, companies are just really performing at a high level. And then on the other side, you have the consumer and the labor market in the U.S. Signs of cooling, but not outright signs of weakness, right? Signs that maybe we can't continue economic growth at this above trend 3-ish% level, but by and large, still a consumer that is in good shape, is not, has an income, is working, and has a really solid balance sheet in terms of not a lot of debt, and again, strong income and strong net worth.
So how does all this look, the tariff situation and the threat of an economic slowdown, how does it all look to the Fed? I've read some of your notes, and you caution investors against expecting the Fed to rush to the rescue here with rate cuts.
Yeah, I do think that there is a concern, at least one of my major concerns is the potential that the Fed needs to cut to support the economy, but is hesitant to do so because of the potential inflationary impact of tariffs. We saw something very similar play out in 2018, where the market fell almost 20% in the fall of 2018 because the Federal Reserve was too tight in anticipation of trade war and tariffs raising inflation. But we never saw that inflation materialize, and the Fed was a bit slow to respond to some slowing economic growth concerns. They were able to pivot because inflation was not hot. And so once the Fed cut, we got the Powell pivot, and then 2019 ends up being a tremendous year in the stock market. I think there's more hesitance today because of the aggression of the tariffs, because of the breadth of the tariffs, for the Fed to come to the rescue and really put that, Powell put or Fed put into place.
What sectors of the U.S. market do you like longer term when you look through this tariff situation?
Yeah, well, number one, I think that's the right way to do it. When the tariff situation is as uncertain as it is today, right? Day to day, we don't know what the levels are, who's in the crosshairs, are there industries accepted? So I think you have to pull back and kind of focus on basics. And in this environment, higher for longer rates, middle to late part of a business cycle, we want to own high quality names with strong balance sheets, strong cash flow. And with the Mag 7 and big tech weakness, I think you start there. I think you look at the weakness and say, okay, even if the technicals aren't very good and maybe there's more downside in the next couple of months, we want to own secular growth trends over the long term. These companies are cash rich, low debt, they have strong businesses, and they have the optionality or the call option of AI kind of blowing up in the way that a lot of people hope it does. So I would start there, especially if you have a time horizon that can withstand, some additional chop here in the near term.
What's your take on U.S. retailers? I spoke with a U.S. retailing analyst yesterday who said, depending on where these companies source many of their products, some of them will be forced to raise prices significantly because of tariffs. A classic example, in his opinion, or a prime example, Best Buy, which gets a lot of its electronics, of course, from China.
Yeah, so I think two ways to look at it. individual company level, there are obviously companies that import a lot of goods, whether close to finished goods or raw materials and parts that go into that are part of their supply chain, that will obviously be just cleanly impacted by tariffs, right? Straight, it's a tax hike that goes straight to the bottom line. They will attempt to pass on price hikes. I think companies have gotten a lot more comfortable trying to pass through price hikes after the bout of inflation we saw in 2022. I think the consumer is in a good enough place to accept some of that, but certainly not as strong as they were, in 2021 and 2022 when companies did this the first time around. On the consumer side, they don't necessarily have to accept price hikes. There are a lot of substitutions for goods that can be done, whether it's a U.S. producer or a producer that's not necessarily directly in the crosshairs of tariffs. So for a lot of goods, there are substitutes out there that keep the consumer from being directly in the line of sight. But with the breadth of tariffs we've seen proposed, it's going to be really hard for the consumer to emerge unscathed here.
What's your take on the U.S. banking sector, which is broadly exposed, of course, to the entire U.S. economy?
Financials took it on the chin yesterday, but broadly in the context of an uptrend, global financials have looked pretty solid. There's obviously a very kind of clean deregulatory push that should help their productivity and bottom lines. We've seen a nascent uptick in M&A and IPO activity, the kind of capital markets activity that had been really suppressed over the last few years. So I continue to like financials here. I think it's as clean a play on the tailwinds that the new administration brings to the economy. A slower economy is not necessarily a huge headwind. An outright recession would be, but I don't think that's in the cards in 2025. So I continue to like the financials here. I think there's a lot more tailwinds than there are headwinds. And to the extent they're caught up in this trade war sell-off, I would be a buyer.
Ross, thank you for joining us today. Ross Mayfield is an investment strategist